Investing across asset classes. A breakdown. You've got a sweep of topics, all aiming to turn money into a working partner rather than a passive observer. Below is a practical, investor-friendly guide to how to approach each area with actionable steps, typical risk-return notes, and considerations. I'll keep the math approachable and provide starter ideas you can tailor to your situation. 1. Assets versus liabilities. Is your money working for you? Core idea. Assets. Things that generate cash flow or appreciate in value through rent, dividends, interest, or capital gains. Liabilities. Costs or debts that drain cash. High-interest debt, depreciating assets without returns. Practical steps. Net worth snapshot. List all assets, home, investments, savings, and liabilities, mortgage, credit card debt, loans. Subtract liabilities from assets. Cash flow check. Track monthly income from assets versus monthly outflows, debt service, living expenses. Aim for positive or growing passive cash flow. Action plan. Eliminate or refinance high-interest debt. Convert or finance underperforming assets into cash-flowing assets, e.g. rental property, dividend-paying investments. Build an emergency fund and investable reserve. 2. Real estate. The math behind making $1,000 a month in passive rent assumptions. Simplified example. Target passive net monthly cash flow, $1,000 after mortgage, taxes, maintenance, and vacancy. Typical inputs. Purchase price, down payment, loan terms, rent, operating expenses. Rough framework. Estimate gross rent, monthly rent you expect from the property. Deduct operating costs, property management, if any, maintenance, property taxes, insurance, HOA, vacancy rate, debt service, monthly mortgage payment, principal plus interest, net cash flow, gross rent, operating costs, debt service. Cap rate and cash-on-cash return, cap rate, shocker, net operating income, NOI, property price, excluding financing. Cash-on-cash return, annual pre-tax cash flow, total cash invested, down payment plus closing costs. Quick example, very rough. Purchase price, $300,000, down payment, $60,000, 20%. Loan, $240,000 at 6.5% for 30 years. Estimated gross rent, $2,200 month operating expenses, taxes, insurance, maintenance, vacancy, $500 month mortgage payment, $1,518 net cash flow, $2,200, $500, $1,518, 182 month before tax. To hit 1,000 month net, you'd need either higher rent or lower expenses, or more units, or a different financing mix, e.g. larger down payment, lower rate, shorter term, or a value-add strategy. Renovate to raise rent. Practical guidance. Start with education, local market rents, cap rates, typical vacancy rates. Use a conservative estimate for rent growth and vacancy. Consider leveraged real estate ETFs or REITs for exposure with lower friction if you're starting out. If you pursue direct real estate, run pro forma cash flow under multiple scenarios. Base, optimistic, pessimistic. Plan for property management, either self-manage or hire a manager. 3. Dividend ETFs, SCHD, NOBL, and cash flow strategies. What they are. Dividend ETFs hold a basket of high-quality dividend stocks and distribute cash dividends to you quarterly or monthly. How to invest for cash flow. Set income target, e.g., X per year in dividend income. Estimate yield. Dividend yield. Annual dividends, share price. For SCHD, NOBL, long-term yields often in the 2 to 4% range, varying with market cycles. Calculate required investment, required capital annual income, target yield. Example, 6,000 year at 3.5% yield, $171,129 invested. Diversification and risk. Dividend stocks can cut distributions in downturns. ETFs help diversify but aren't risk-free. Practical steps. Start with a small, regular investment into one or both ETFs to observe how distributions behave. SCHD, Schwab U.S. Dividend Equity ETF. Focus on quality, dividend growth, no BL. Invesco, S&P 500 equal weight dividend ETF. Equal weight tilt may give different sector exposure. Reinvest or take cash as needed. Reinvest.